Hey there. If you've ever been offered compensation in the form of company equity, you might be wondering, how are RSUs different from stock options? Understanding these differences is crucial as they can significantly impact your financial future and taxation strategy. In today's guide, we'll break down the distinctions between restricted stock units and stock options so you can make informed decisions about your compensation package. What are RSUs? Restricted stock units, or RSUs, are a form of equity compensation that companies offer to employees as an incentive. RSUs represent a promise to issue a certain number of shares to the employee at a specified time in the future, provided certain conditions, such as continued employment, are met. Unlike stock options, RSUs do not offer the right to purchase stock at a discount, but rather give you the actual shares once they vest. The value of RSUs is based on the current market price of the stock at the time they vest, which means they have intrinsic value at that point. What are stock options? Stock options, on the other hand, are a different beast altogether. When a company grants you stock options, it's giving you the right, but not the obligation, to purchase a specific number of shares at a lower price and then sell them at higher market value. However, if the market price never exceeds the strike price while the options are exercised, the main attraction here is the potential to buy shares at a lower price and then sell them at a higher market value. However, if the market price never exceeds the strike price while the options are exercisable, the options could end up being worthless. Key differences: vesting and exercising. One of the primary distinctions is how RSUs and stock options vest and operate. RSUs automatically convert into shares upon vesting, meaning that once the vesting period is complete, you own the shares outright. Stock options require an additional step: exercising. This means you need to take action to purchase the shares at the strike price once they vest. Tax implications. Tax treatment is another significant difference. With RSUs, taxes are typically due upon vesting, since that's when the shares become yours. The fair market value of the shares at the time of vesting is considered ordinary income. With stock options, taxes are incurred when you exercise the options, and the taxable amount depends on the difference between the market price and the strike price. Long-term capital gains taxes can apply based on how long you hold the shares after exercising. Risk factor. RSUs are generally considered less risky than stock options because they always have value once vested, assuming the company's stock is worth something. Stock options, conversely, only have value if the stock price stagnates or drops. Making the right choice. So how do you decide between RSUs and stock options? It really depends on your financial goals, risk tolerance, and the structure of the offers. If you prefer a less risky approach and want guaranteed value, RSUs might be better suited for you. If you're cool with taking a gamble for potentially higher rewards, stock options could be the way to go. There you have it, a clear breakdown of how RSUs differ from stock options. Whether you're navigating a new job offer or considering your current equity compensation, understanding these differences will empower you to make better financial decisions. Remember, each comes with its own set of rules and implications. So take the time to evaluate your own financial situation and consult with a financial advisor if necessary. Thank you for tuning in, and here's to making savvy financial choices.